I want to bring in TPW Investment Management co-founder and CIO Jay Pelosky and Brandywine Global Portfolio Manager Jack McIntyre. I want to get your takes on what the Fed said today. Jack, you know, it's interesting because when Powell was giving that speech, I thought this was interesting. He goes, well, and this is where I get my mission accomplished joke out of today. With solid household and business confidence, healthy levels of job creation, rising incomes, and fiscal stimulus are arriving, there's good reason to expect all of this is going to continue. Pat in the back.
Yeah. I agree, actually. I think it's a little bit of the Goldilocks sort of scenario because, yeah, we've got growth, but what makes this cycle a little different is that it's not associated with a lot of inflation. And the thing I liked about Powell, his speech was they're looking at a qualitative aspect about steady monetary policy. It's just not looking at where inflation is today. It's looking at the sort of secular disinflationary influences that are going to maybe keep a lid on inflation relative to growth, and that the equity market loves that. Yeah, and Jay, he also, to pick up on that point about inflation, he said, while inflation has recently moved up near 2%, we have seen no clear sign of it accelerating above 2%, and there doesn't seem to be an elevated risk of overheating. Yeah, and I think what's interesting there, Cheryl, is whether that means that we're setting up for the Fed to pause. And I thought the earlier comment about the Atlanta Reserve Chair saying that he's in favor of 3 hikes, not 4. For the year. Yeah. The market is priced in 4, so 2 more this year. And I think if we do get to a Fed pause, I think that's going to have significant implications for how investors are positioned. Because right now, investors are record long the U.S. and record short safe assets. So short the dollar, long the dollar, but short gold, short treasuries. Yeah. And so positioned for this kind of like thread the needle Powell speech, but not prepared for any kind of change. You know, I don't know, Jack, though. Okay, so say that they don't raise rates. Say that they raise rates in September, which is pretty much baked in, but then they don't in December, then they're going to have to do it in January. Not necessarily, because I like the yield curve, the message embedded in the yield curve, and I know Bostic does too. He said he's not going to preemptively tighten rates to invert the yield curve, and I think that's a key message, is that the Fed doesn't get aggressive. They don't invert the yield curve. That would be a bad thing. Yeah. The flattening yield curve has certainly made a lot of folks worried, you know, Jay, because that means you might have an impending recession. And that wouldn't be out of the question, considering that we've had this 9-year bull market, and we are seeing there is some inflation out there that wouldn't be so far off the reservation. Well, that's what I think is interesting, that investors are record short safe assets, because there are plenty of things that one could get concerned about, right? You do have the trade uncertainty, which starts to slow corporate, the C sector, the C-suite. If they start to slow CapEx, you already see signs of consumers kind of rolling over. Consumer sentiment is down, housing is down, autos are down. So you're really dependent on that CapEx side and CapEx cycle to work. And if you have the trade uncertainties and you have a Fed that's maybe being a little bit too aggressive, then 2019 starts to become an issue. And I think our colleague, our other guest here, is right. It's not necessarily a given that if they don't raise in December, that they necessarily raise in January. Well, and also, Jack, I mean, they did talk about it in the minutes. We got those on Wednesday. They did talk about the issue of tariffs and potential. They didn't use the word trade wars, but they did speak about the fact that that's somewhat of the unknown. And that could be the way that they tip their hand. I agree. I mean, actually, I think there are quite a few unknowns, and certainly the trade tensions, the risk that that's going to escalate is there. You're already seeing, and they referenced this today in the speech, you're seeing some stress away from the U.S. China's been slowing. They're clearly EM. Markets are kind of coming unglued in the near term. That's not going unnoticed by the Fed, and it tells me that when the Fed focuses on that, that's a little bit of code that, hey, the dollar might be strengthening a little too much in here. So I agree. I think the U.S. dollar could come under some pressure. Because you know what, Jay? At the end of the day, having a mix of your portfolio, having some emerging markets, having some other first world markets besides the U.S., nobody wants to bet 100% on the U.S. I mean, I love my country, but, I also love my investments. Right, exactly. I mean, diversify. Well, and I think that's what's interesting. Investors are record long U.S. assets. So whether it's U.S. equities, U.S. fixed income, investors around the world are long the U.S. And that's been the right place to be. We do international, global, multi-asset investing, and the only place to be this year has been the U.S. and U.S. growth stocks. And so if we have a change in regime, that can have significant implications for how investors should be positioned. And I do think the surprise would be that the Fed pauses, that the dollar rolls over, and some of the things that have underperformed the first part of the year start to outperform. Jack, I'm going to give you a final word. How do you play all this? Actually, I agree. Not to be boring, but yeah, if you haven't done so, I would shift some assets out of the U.S. and take advantage of this huge sell-off that we've seen in emerging markets. I think it's I'm not going to say next week things are going to recover, but if your time horizon is maybe a quarter to a year, I got to believe you're going to do well by doing that.
Oh, Jack, the minute you were talking a couple of questions ago, I thought, emerging markets. Let's take a look at that. Yeah, looking for the buy low, sell high. I mean, it's all about making money. Yeah. Jack and Jay, guys, thank you very much. It's great to have you both here. Appreciate it.